Oh, wow. Now we're being recorded. I'm kidding.
That's the first time in the recording.
Yeah, so that's my background. So more so, the reason why I wanted to introduce you guys with that is it's going to be important. Some of the stuff that we're going to be talking about today is going to be about programs that require thinking. We've kind of migrated away from thinking since the technology world came in and automated underwriting systems came in, and it started making decisions for our underwriters and our credit policy people. And with the stuff that we're going to talk about today, it's going to take us back to the manual thinking, credit, all that piece shortly here. But I mean, so at Arcstone Financial, we offer a variety of products, obviously. So we go from the bread and butter type programs, which is going to be the 20% down or 3% down, whatever it may be, the Fannie Mae, Freddie Mac programs, which I'll talk about momentarily, all the way to construction loans, to reverse mortgages. So we'll touch base on some of those bullet points until we get to our highlighted program, the products that we're going to talk about today, which I feel like is going to help everybody understand that there is a loan for everyone, and also help you guys create wealth through the process of acquiring properties or selling properties. So I'm excited to talk about it. David had asked me to talk about some of the products that are the well-known products, which is going to be one of the things I wanted to, I guess, bust the myth with you guys is the concept.
No. It's his dial-up again. Maybe he can come here.
Marty, you're frozen. We're not hearing you.
We'll go save the day. 1 second.
Thank you, John.
Yeah, I think.
All right, he is resetting. I guess his computer froze. Can you guys hear me?
We can hear you. I know you see Marty, he's back, but he's muted. Now he's unmuted. Welcome back.
I have no idea what's going on, guys.
I'm
sorry.
guessing, may I guess, you probably have too many computer programs open on your computer.
Ooh, very, very good observation. Let me try to do that, guys. I'm so sorry. Yes, I probably do.
You probably have 50 tabs open, no word of a lie, 50 tabs on 3 different screens. Which equals 150.
If I'm so sorry, let me just make this real quick adjustment on my end, and let's. That very might well be Candace. So
it's okay.
I'm just impressed that Candace had a technical, suggestion or solution here.
We're gonna be calling you for tech support from now on, Candace. All right. Well, let's proceed. I don't. It's not allowing me to close them, but let's not make this about the computer. Hopefully. All right. Well, we were talking about private money, right? So we're talking. I was mentioning that private money is a word that's been associated with a negative term because it's associated with a higher interest rate, and or maybe such, like the word of hard money is associated with private money as well. What happened in 2008? When things went down, where the banks started closing down, mortgage companies were imploding. The credit piece was definitely shrinking, and our credit box was shrinking. So hard money and private money came in to save the day, and they were coming in with higher interest rates. And so because of that, it stuck around for a long time because that was the only way that, you know, investors were able to get loans. And, you know, a lot of times when I say private money now, people go hard money. So I really want to start, you know, with that piece of what private money means. And I want to, you know, share that with you guys. So when we go to, when you go get a loan, there's going to be a few different places where you could get financing from. And the banks are going to have variations of places where they get their money from as well too. Obviously, we get our money from the Fed to start off with, but there's agencies such as Fannie Mae and Freddie Mac that create liquidity for homeowners, for us mortgage companies to be able to give loans and those loans to be purchased and securitized by these agencies. And we call them in our organization, in mortgage banking, we call them agency loans. And agency loans are, like I said, backed by Fannie Mae and Freddie Mac. And we also consider Ginnie Mae, which I'll talk about in a minute, as part of the agencies as well. And so Fannie Mae and Freddie Mac loans are going to be those advertised loans that you see online, where it's going to be 97% financing, where you could put 3% down, or that 95% financing, 90, 80, all those variations, obviously. There's also, you know, Fannie Mae and Freddie Mac have stepped into various different programs as well, where they wanted to give construction loans. They're considered home style is a construction loan that they do. These are all programs that we do over here, just so you know as well. And a construction loan is going to be for someone that wants to buy a property, improve it, and live in it, obviously. And they're going to be, they're not for flippers, they're not for things of that nature. They're not spec home type properties. They're just for people, built for people to create home ownership possible, obviously. And that's the whole purpose and mission of Fannie Mae and Freddie Mac are, obviously, just to create home ownership possible. And then we have Ginnie Mae. Ginnie Mae is the institution that buys government loans. And those are the loans that are insured by the VA, the Veterans Administration, and HUD, which is Housing and Urban Development. So, and I think a lot of you guys know the word FHA that's associated with HUD, and that's basically the program that will be, you know, insured by HUD and sold, securitized by Ginnie Mae. And I'm talking really high level right now because I really want to make sure that you guys understand that there's private money and there's agency money. So I'm talking about all the agency money programs right now that are easily liquidated and sold on the secondary market from us. So when COVID hit, a lot of us were worried in the mortgage banking industry because liquidity, we thought liquidity was going to shrink. No one was going to buy loans on the secondary market, but thankfully the government stepped in and pumped a lot of money with it for Fannie Mae, Freddie Mac, and Ginnie Mae. And they said, continue buying loans from mortgage companies. We are not going to stop this. We're going to continue home ownership and we're going to create liquidity in the marketplace. So that helped us a lot, thankfully, where it gave everybody the confidence.
We've lost you, Marty. We can't hear you and your screen is frozen.
Yeah, he's probably gonna reset. I think we know the pattern here.
Did you invite him to come in the conference?
Yeah, I did. He wants to have.
Wants to from
Yeah.
there? Okay, I got it.
Do you think he knows he froze? He's frozen?
Hey,
One of you
Chris.
guys want to run? There he is.
There you go.
We hear you.
We keep freezing, baby.
Yeah, it's like my heart. I don't know what to say. All right, guys. So I don't think my computer likes Fannie Mae and Freddie Mac talk. I think I should talk about private money. So maybe that's what it is. Anyway, so what I was saying is that, you know, when Fannie Mae and Freddie Mac created that liquidity, they private money people such as banks and hedge funds decided to step into the mortgage space a little bit more aggressively because they felt the backing was always going to be there and they were not going to let the mortgage companies and the housing market bust, basically. So so recently, I don't know, for those of you that have been doing real estate or buying properties, obviously, recently, I don't know if you guys have been noticing that the guidelines are loosened.
You just froze, Marty.
Loosening up.
Transformative.
Yeah, I know. Yeah. So what happening? What happened was they started loosening the guidelines, and so now there's a lot more liquidity, and you guys are probably experiencing that because you're probably hearing some of the programs being a lot more looser. For example, like jumbo programs recently. Previously, we were stuck at a certain debt to income ratio where you could not actually exceed a particular debt to income ratio. Now that ratio has really increased significantly as of the last 6 months, and used to be at 43%. Now you could go to 50%. What that means to real estate people and also for consumers that are buying homes, that if they were capped at, let's say, a jumbo loan in Los Angeles is going to be anywhere over 822,000. So if you were capped at, let's say, 900,000, now you could actually buy something up to like $1 million because your debt.
Curious.
Marty, we just lost you. You're frozen. That was
No, he's coming.
interesting too. So.
He was gonna come back.
Okay.
So where we left off was the guidelines were obviously getting looser, and we could actually go at a higher dollar amount for purchase prices, obviously. So what I'm going to do is I'm going to go into the next sector of the programs that we're going to talk about. I'm so sorry, I totally lost my train of thought here. And we're going to talk about some of the programs that Arcstone has curated, because my background being in capital markets and creating programs for some Fortune 500 companies, I basically was able to tap into my Wall Street contacts and our hedge funds that we work with and create our own particular programs. And that's considered private money for us, because we're not selling these loans to the Fannie Mae's and the Freddie Macs and the Ginnie Mae's of the world. The agencies is what we call them. We securitize these things with hedge funds and also like with Wall Street money. We're going to go into each one of these programs in greater detail, and so you guys can all understand how do you monetize and use these for your own personal, either purchasing a home or selling homes for your clients. I feel like this information is very important to get out to your clients, because a lot of people have this misconception that they cannot buy a home because they are self-employed, or they were given some data that from their cousins or family members that they could not buy a home unless they had a steady paycheck on a month-to-month basis. Let's go ahead and see if I could go into our website here and share my screen with you all. This is so distracting here. Let's see.
The screen is not shared yet. It will be though.
All right, perfect. So, so these programs that we created, we private labeled them, and we call them AMP, A-M-P, Accessible Mortgage Programs. And these programs are catered for people that are not able to document their income through traditional manners, such as their taxes or pay stubs. Because when you go to a bank underwriter is looking for stability. They're looking for a paycheck. They're looking for someone that is making consistent amount of money for the last couple of years. And if that ever varies, you're not going to become a candidate for a loan at a bank. And even for an agency program, because Fannie Mae and Freddie Mac, that's the old school way of thinking of, okay, if somebody doesn't have stability, doesn't have paychecks, that is not a good candidate for a mortgage or a good candidate for a repayment of a loan. So we think outside of that box. In my experience of doing this for 27 years now, I've found that self-employed people have been a way higher performing group of people than a W-2 individual. Where, I mean, the thought process behind a self-employed person is you've got the hustle. If you don't have that money coming in, you're going to go out and do a few other things to make sure that you meet your obligations. Whereas a W-2 individual, we've always found that if they lose their job, it takes a little bit. If it's a downward trending employment market, it becomes a tougher situation where they actually cannot make their mortgage payments for a lengthier period of time, and they result in foreclosure a lot more than a self-employed individual. So yay to all of you in real estate that you guys are out there hustling it and making sure that you actually are able to meet your obligations, obviously. So let's take an individual that's self-employed, and let's utilize this, example. Let's take a realtor, right? So sometimes a realtor makes great money, 1 month, and then they all of a sudden the following month there's no sale, or the following month there's no sale again, and then in 3 or 4 months again they might have 4 more sales, essentially, just because listings, it ebbs and flows. And then sometimes what will happen is these sales, as you know, like you might start a transaction in November, it might not close until January. You might fall into the following year. You thought, hey, I'm making so much money here, but it's not really translating to income on your taxes. And some realtors also are incorporated. So they'll take that income and they'll write down every last dollar and make it where they don't look like they're making any money on taxes. So what will happen is they'll go to a bank and they'll say, what are you talking about? What do you mean I can't afford a home? I mean, I just sold like 25 homes. I made $500,000, but the underwriter looks at it and goes, well, it looks like you made $25,000 this last year because you were so creative and your account was so good. And all of a sudden your income is not there. So we said, these people are underserved. These programs are not available. When I started in the business in 1994, we literally looked at everything from beginning to end. We looked at the person's income manually. There was no automation. We made sense out of the individual. We're going backwards now again, and we've created these programs where we're bringing this, the thinking back into the underwriting process, and we're saying, okay, I'm going to use you, Candace, for example. Right now, we're going to say, okay, Candace, well, give us your 12 months of bank statements for the last 12 months. Give us your 24 months of bank statements. Let's see what is going into your account. And let's utilize this method to qualify you. Because now, truly, to me, that is the actual way of looking at someone's income, because that's what you're depositing in your bank account. That's what's coming into your cash flow on a monthly basis. So what we'll do is we'll analyze your bank statements and give you a loan accordingly. So we'll take every single deposit on a monthly basis, and we'll make sure that it's divided by 12 months, and we'll use that deposit as your monthly income to qualify. You don't know how many loans that were denied for so many clients at banks or even at other mortgage banking firms have turned into a mortgage where it was a closed loan. I'll give you guys another example. An individual that not only writes down stuff off their taxes, but they also have inconsistent income as well too. This helps us look for a person, let's say, for example, a writer, somebody that writes novels, writes a book 1 year, doesn't write a book the next year, writes another book the following year. This is something that we've encountered. We'll stretch it out over 3 years. We'll say, okay, let's look at your 3 years of income and make sense out of the situation. So it's really unconventional. It's very different of what the underwriting process would be normally. So it's really important for you guys to keep that in mind. And the consumers that are going to be perfect for this is going to be like, it's only for the self-employed people. And also businesses have changed, right? So now we have different types of businesses. People are driving Uber. People are delivering food. They're doing tasks out of it. So this is income coming into their accounts on a monthly basis. And they can't show that on their taxes perhaps properly, or they're not getting the 1099s or whatever it may be. Or they might do, cash business. They might be doing something on construction, and we're actually depositing these funds into their account. We'll actually be able to use that as cash flow for our, yes.
And I would also just like to make a quick note of two really good examples being in Los Angeles. Basically, anyone that works in the entertainment production space and athletes that have houses in Los Angeles. Those are two really valuable customer leads to chase with this product.
Yep, entertainment industry is probably 70% of our business over here. And we, like, this is how they get loans generally. And because when they go to other banks and or institutions, they get declined sometimes, and we have to structure it this way. What we'll always do is we'll start off by looking at their taxes. We'll do a process of elimination, because our goal is to provide them with the lowest possible interest rate and best possible scenario for them. So we'll start off with their taxes. If it doesn't work that way, we'll go to the bank statements and then various different programs. So let me start off by sharing my screen, if that's okay with you, Candace. And so that way you guys could see, first and foremost, introduce our website to you. And then secondly, we'll talk about the programs and how you guys could actually access this information without, because I'm giving you guys a lot of information at the moment. So can you actually see my screen now? You can. Okay, great. So first and foremost, our website is arcstoneinc.com, ARCSTONEINC.com. And if you go to Resource Center over here, you'll see a section where it says AMP. Let's go there. And AMP is our accessible mortgage program. You've got 4 programs that will fall under the AMP program. It's going to be bank statement loans, which is what I just covered. There's going to be profit and loss statement loans. There's asset-based loans, and then cash flow loans. I'm so excited to talk to you guys all about this today, by the way. So this is really cool that you guys are getting a preview of it. So let's start here. We already talked about the statement loans, and it's, it gives you an idea of who the actual person that could actually get this loan would be is the business owners, freelance employees, consultants, contract workers, independent contractors, sole proprietors, gig economy workers, realtors, entrepreneurs, right? Like, it's all descriptive of people that are not getting consistent income. And hopefully they're getting consistent income, but it could result in inconsistent income as well. The good part about these programs is that we'll go all the way up to 5 million on our regular guidelines. The loan amount could be $5 million, and we'll go all the way up to $20 million on a loan. So yes, if you're in that space of doing larger transactions, we'll give you a $20 million loan if need be. The program goes as low as 10% down. It does not, that doesn't mean that the $20 million person is going to put 10% down, guys, by the way. But the program does allow you to get to 10% down. So a lot of places will cap it at 20, so we'll go down to 10% down. The program is getting a little looser. We might have a 5% down program here coming out soon too. So the good part about this page is that you can, as realtors, you guys can download the brochure first right here, if you guys click on it. So if you want to read up on it or share this information with your colleagues and or your clients, you can do that. Oh my God, today's not our day. The internet for some reason. Yikes. Give it another second. Yep, there we go. So there's a brochure that you guys can actually print and share it with your colleagues and or clients and or wow, maybe it's me. Maybe I've got a magnetic field here that's killing the call me Magneto. Or there's also a social media piece that you guys can post on your Instagram and or Facebook to give your clients and colleagues also a look of what the program is. Moving on to the next, and that would be profit and loss statement. This is a really specific program that to Arcstone Financial. And let me go back for a second. The bank statement program, the rates are in the low 3s, guys, like 3.25, 3.375. very, very few, about like a quarter to maybe a half of a percentage point from prime interest rates. A jumbo loan today from with full documentation, you could probably get a 2.875. This program is going to end up being at 3.375. So it's not like it's going to be significantly higher interest rates. The next exciting program that I want to talk to you about is profit and loss statement programs. This is wonderful. Like, this is the simplest loan type that we have over here, and where you go to your CPA or you go to your enrolled agent, and there's specific types of people that could do this for us, and I'll highlight that. And they'll provide you with a CPA or an enrolled agent prepared profit and loss statement. You provide us with your profit and loss statement, and we will look at that bottom line number and use that as your income. As long as it's prepared by a CPA, a California Tax Education Council individual, or an enrolled agent. It can't be just an accountant or a bookkeeper. It can't be anything like that. You can't just print out a QuickBooks profit and loss statement and give it to us. It has to be prepared by a CPA. The good part about this is that CPAs understand your pre-tax dollars, and you can give us pre-tax dollars without having to give us your actual taxable dollars, essentially, which makes sense to us, and we could, break that income down much easier. We don't have to look at your 12 months of bank statements or your any other documents you provide us. So this to me is really exciting. It's great. It reduces the amount of documentation you provide us. It's one piece of document, which is your income, and that's the CPA letter. And this program too goes all the way up to $5 million on our guidelines, and it will also go up to $20 million off of our, like, if we need to go up to that dollar amount, we can go up to that dollar amount. So moving on to the next program is asset loans. And this is interesting because we talk about this new age of currency nowadays. There's all sorts of cryptocurrency and Bitcoin and things of that nature coming onto the marketplace. And so it's exciting. A lot of people have been making a lot of money. So asset loans have been really interesting just because in 2020, as we know, the stock market has done phenomenally well. A lot of people have created a lot of wealth, and they have a lot of money sitting in their bank accounts. And what we'll do is with asset loans is we'll take their bank statement, and if we see that they have enough money to so what we'll do is we'll take $1 million, let's say. If you've got $1 million sitting in your bank account, we'll annualize that. What does that mean to you? So we'll take that and divide it over 7 years, which is 72 months. We'll divide that and say, what is the dollar amount going to equate to $1 million divided by 72 months, which is 7 years. And that turns out to be about $13,800. So we'll actually use $13,800 as your income on a monthly basis to qualify for a mortgage. This used to be a problem because people would come to us prior to these programs, and they may have been retired, but they had a lot of money in their bank accounts. And because in 2010, Dodd-Frank came out and they said, Marty, as a mortgage company or a bank, you have to make sure that you have validated the individual person's income. It's called ability to repay. And if you do not validate their income and they go into foreclosure, you as a mortgage company will have to make their mortgage payments for the next 3 years, or let them stay in that house for the next 3 years. That's why banks are really tight, and they make sure that they check everything and make sure that they're not going to be exposed to lawsuits down the line. What this does is allows us to take that bank account and make it into an income stream, essentially, instead of looking at it from an asset stream. So it's helpful because it allows for retired people, or people that have made a lot of money recently that have not reflected on their taxes to show us a bank statement and qualify for a loan without having to provide income documentation. This eliminates a lot of paperwork as well, because we only need 2 months of bank statements from the individual to show that money is there and it's seasoned. Sometimes this money comes as a form of a gift. It doesn't mean that it has to be acquired money through your job or accumulated money from a stock trade or whatever it may be. And recently, we strike the deal with our banks, with our hedge funds, that we will allow for cryptocurrency to be used as well too, as a form of assets. So cryptocurrency is here to stay. We recognize it. We understand it now. Goldman Sachs is getting in it. MasterCard is getting in it. A lot of different, institutions are now recognizing that it's not going anywhere, basically. So we also in the mortgage industry are, understanding that this is something that we need to accept and also utilize, because people are actually cashing them out and, buying properties. I mean, there's been transactions that we all know about that has come into fruition with cryptocurrency recently. So, which is wonderful to see. Lastly, which is it's the most creative program and the most interesting one, is going to be our cash flow analysis. So as you guys know, we do commercial lending at Arcstone Financial as well. And if any of you guys have done any commercial financing or bought a commercial property, you understand the term debt servicing or debt service ratio. This is something that's utilized in the commercial lending world often, because that's how you analyze if a property qualifies for financing and what type of cash flow it has. So when you go to, let's say, get a commercial property, they'll say, you know what, we don't care about your taxes, just let us know what the rent rolls are of this property, and let's figure out how much money we can give you. So in order not to go into the commercial world, it's very similar to a commercial loan. And we took it and we mimicked the commercial programs, and we said, all right, what if somebody, let's say, Zoe's going to go out and buy a property and her taxes are not documenting enough income, and also she is, what else that could be here? She may have over 15 financed properties. She's an investor and she cannot get a regular loan. Her bank statements are not showing enough deposits in them. She is a property flipper. A property flipper is probably the best example you can give in this particular case, because property flippers, generally what they do is they have capital gains. When they buy a property, they sell it for a higher amount. They have capital gains and they write that capital gains almost to nothing on their taxes. It looks like they're losing money every time. And an underwriter gets the file and goes, why are you doing this? Why are you doing peer review? You're always losing money on this thing. But they're like, no, we're not really. We're always making money, but they're really, they're showing their income to be lower. So they're generally, a property flipper doesn't have monthly deposits. They might have a huge deposit coming in once a year, twice a year, or depending on how often they do it. But this allows them to basically go out and buy a property without giving us 1 ounce of documentation. And why? Because what we'll do is we'll look at the rents coming in from the property, and we'll compare it to the property principal, interest, tax, and insurance. So for example, let's say we just recently did a transaction for somebody that's buying a property for $1.8 million in West Hollywood. They bought it for 20% down. The payments were about $9,000. We did a market analysis on the rents, and it was going to be $10,000 for the rents. So as long as 1-to-1 ratio, the $9,000, the $10,000 covers the $9,000 of principal, interest, tax, and insurance is covered, we don't need 1 ounce of documentation for the borrower and anyone to close this transaction. These are great because they close really fast. They're called business purpose loans. They're higher interest rates. They're about 4.5% interest rates, but they close really like within 7 to 8 business days. If you guys ever need to close a transaction really quickly, it almost mimics a hard money loan. They can or they cannot have a prepayment penalty. So a hard money loan is not going to have a prepayment penalty, but they are going to charge you points. And these programs do not have points. Why I like this is because if you guys have clients that are property flippers, they're worried about the margins on the transaction. So for example, if they go buy a property and they have a 9% interest rate, right? That eats away from the holding cost of the property. So now if the cost of the interest was $90,000 for a year, by a lower interest rate, it might drop down to $40,000 for a year. So now they've got a $50,000 profit that they can hold on to. There's no points. Generally, when you're buying a property with hard money loans, you get to pay points, 1 or 2 points minimally. So that's like $10,000, $15,000 saved right there. So it makes a transaction that was maybe not doable for that flipper. Now all of a sudden they have a $70,000, $80,000 profit. It might look a lot more attractive to them at that point. So you really want to keep this in mind when you are dealing with investment properties that are have potential for your flipper clients. So it's really important to do that. Now, the great part about this as well too is that the property can be vacant. We'll use market rents. They don't have to be rented. Commercial lending, they have to be rented. Otherwise, it takes away from the income of that property. So let's say if you come to me with a 5-unit property and one of the units is vacant and I'm doing a traditional commercial loan for you, I'm going to take away that one of the units that is not rented. I'm going to take that rent away from you, and I'm not going to give you credit for that. Whereas this program will allow you to use market rents to qualify. Now, the other wonderful thing about this program is that we'll go all the way up to 8 units. You're not capped at the traditional residential 4-unit property. So you can buy a single family, duplex, triplex, fourplex, 5, 6, 7, 8 units, and it's the same guidelines all the way across. So it creates for a lot of opportunities. There's this new trend coming on into our market over here in Los Angeles, which has been around in San Francisco for some time now, and that's tenancy in common. What people are doing is they're buying properties in this kind of a format, up to 8 units. They're converting them into tenancy in commons. I know we just did one for someone Zoe and I know, and they're flipping them out, turning them into tenancy in commons and selling them as individual units. And this person is making a killing doing them, which is great. Very proud of him. So this program is definitely something to be publicized. I want to make sure that a lot of you know about this, because it's just going to make financing accessible. All of these is what I consider private money. So this is coming from hedge funds. Banks will never understand this. Banks will never dip their toes into this because it takes too much manual power for analyzing these programs. We're actually going to call this program Analyzed Mortgage Program, but we said that might be the right word to use because it takes a lot of time from our underwriters, but it definitely makes availability for people to buy homes and or invest and create wealth. One of the things I wanted to throw out there as well as an example is a famous singer recently we did a loan for, had made about $6 million in 2019. They made about $4 million in 18 was 5 million, 19 was 4. 2020 was, no one was out there doing any concerts or anything to that effect. So they made about $3 million, a measly $3 million, right? So they had gone to 3 different banks, and the bank is like, your income is dropping. We can't give you a loan. We don't understand. But they're buying a $2 million house. They're super qualified. Their debt to income ratio is like 11%. I was like, how is this possible that you can't get a loan? And you're a famous singer. Does somebody not want to give you a loan? So it was interesting to see that. But because it's downtrending, banks look at that as unstable income, declining income. So we look at that as not a problem. So we have an item that we were talking about earlier is we're saying when the banks say no, we say yes. So there you go. And that's the AMP program. I've given you guys a lot of information, and just being a local lender in Los Angeles makes a huge difference for all of you. I mean, obviously we know Los Angeles, Southern California very well because we've been here for 21 years as Arcstone Financial, and as the principals of the organization being doing it over 30 years. Obviously, me 27, my business partner has been doing it for like 35 years. Cumulatively, we understand the Southern California market. We understand California. We used to be, our footprint was a lot larger. We had licenses in Florida, Idaho, Nevada, Arizona, Washington. But in 2008, we decided to focus on just California because we knew it very well. And I just did not want to travel anymore at that point in time. So was like, it's like, forget this, let's shrink down and get back to where our roots were. And so, it's gonna give you guys a huge advantage because we understand it. We care about you. We care about your clients. And we really, at the end of the day, that's my vision, is to come, when I come to work, I really care about our realtor partners. I care about that client because, if they're being given wrong information, it's really important for me to take that myth away from them and qualify them for a loan that they should be getting instead of being declined for reasons that doesn't really apply, obviously. So I think I'm going to stop here, guys. I've given so much information. I'm sure there's a million questions that may come up. So why don't we open it up to everyone's to give a question? Stop share, right?
Yeah.
I have a question with regards to the tenant in common mention that you said. So you gave a loan for the buyer of the property that ended up turning the property into a TIC, correct?
Correct. We did the acquisition.
Okay.
So as a preview, I'm working on a tenancy in common program as well with our hedge funds as well. So
That was my next
to
question.
make it
Okay.
available for us because it makes sense. The private money sector looks for a return on the money. And as we're seeing more tenancy in commons coming onto the marketplace, there's a little bit more to probably originate and provide them with those type of loans. So it's becoming a little bit more attractive. I think a few more people will come into the tenancy in common space as well. But yes, we only did the acquisition piece. It was an 8-unit property in West Hollywood that we did the acquisition on based off of cash flow of the property. We did not look for one thing from the borrower.
Okay.
The other good thing about this is that, when you have tenancy in commons, you have people that are sophisticated. They're not going to be individual buyers. They're going to be LLCs. They're going to be trusts. So we close these transactions in the names of the LLCs and the names of the trusts. So it's very specific to an investor type of a borrower.
But you guys are open to starting a program for actual buyers of TICs, is what you're telling me.
We're working on it now.
Okay.
So again, as I mentioned,
Because right now it's limited to Sterling and who's the other one that's doing it?
I don't remember.
I can't remember. It's just two. Well, it's just two that are offering financing in Los Angeles right now.
Right. Exactly.
So yeah. So that's why I feel like it's an untapped market for a lender. And I know that would be you guys would be a great asset if you.
I mean, the program should be there, David, because we do co-ops. As we get more and more tenancy in commons be available, what we care about as lenders is marketability. So that's all we care about is if this tenancy in common goes into foreclosure, are we going to be able to sell it? That's all we're worried about. So in this particular case, if we have more of these come into the market, and since I'm involved in some of these transactions now, I'm bringing this knowledge to our counterparties to see if we could actually develop a program for it.
Wonderful. All right, great. Thank you.
Yeah, of course. Any other questions? I'm sure Candace, you have a question. You always have a question.
I think to clarify for everybody, because you did go over the 4 different loan programs, which are the ones, does it have to be owner occupied for all of them, or for which in particular must it be non-owner occupied?
So all of the programs can be, well, I shouldn't say that. The first 3 programs can be owner, second home, and investment properties, which is the bank statement program, the profit and loss statement program, and the asset-based programs. The last one, the cash flow program, is only for investment properties. It cannot be in property that you can live in. So you can't buy that property, you can't, cash flow property and live in it, because the purpose of it is there's rents coming in for you to qualify.
Okay, but so for the first 3, does a buyer have the option of whether they want to live in the property or not?
They do. You could buy it as an owner occupied. You can buy it as a second home property. So if you're buying a place in Florida, you could buy it with those programs as well. You could give us 12 months of bank statements and we could do a second home as well. And if you're also going to buy an investment property, we could do it as an investment property as well.
Cool.
Yeah. So the first three are not limited. The last program is only for investment properties. And when I say investment, like non-owner occupied, it doesn't have to be units. It could be single family, it could be a condo, up to 8 units.
Cool. Yeah, thanks for clarifying. And I guess because these are not agency loans, there's no PITI on this, or there's no mortgage insurance on this, PMI.
No PMI.
That's
And
great.
when you do 10% down, there's no PMI either. And PMI only comes in when you put less than 20% down. And so when you do 10% down, there's no PMI, which is great. It's all tax deductible at that point, the interest.
Cool. Thank you.
Of course.
You guys offer IO loans and interest only?
Yes, interest onlys are there, which is great. Now we could qualify the person on the interest only payment as well too, which is great. So if your interest only payments are going to be $5,000 and your principal and interest payments are $7,000, it's going to allow you to qualify with $5,000 payment. So we can offer an interest only payment. So yeah, it's really there to help the person get into a property. But we have to make sure that there's viability behind it, not from a tax only, but also from your bank statements or your profit and loss statement or your assets.
So question from one of our attendees is why would somebody use this over going to a direct lender? Why would they not just go to you guys directly? What's the benefit of working with a direct lender?
What was that again?
What is the benefit of working with a direct lender versus you guys? And frankly, there is no benefit if you ask me. But
versus us?
Yeah.
So we're a direct lender. And
well, by when I say direct lender, I mean the larger institutional bank like Citibank, Union Bank, Bank of America.
Okay.
So, yeah.
So a bank is going to have their own guidelines, and they're going to have a very small box within these guidelines. And the banks only they follow agency program guidelines, and they traditionally have the most restrictive ones. So when you go to a bank, they're going to follow those guidelines, whereas these guidelines are a lot wider. So that's one of the items that's going to be. We're also going to take a little bit more of an in-depth look of your transaction as well, or your income, versus a bank is, you've got your underwriter in Wyoming and you work in LA, and an LA income, they don't understand that. They're like, what? This person goes from one show to the other? What's going on here? So whereas we're like, yes, that's normal.
Yeah.
It's very decentralized, and it just makes it very clunky. It's nothing against banks. Banks are there for a reason. It's a good place to actually deposit your money, but don't get a mortgage from them.
And I'd also just like to add one more thing for that agent that asked that question. As a direct lender and as being local to LA, and more importantly, a mortgage bank that knows the products they're selling and knows how to make products. Ellie behind us, for example, is an escrow with a customer that was about to lose their deal. How long was your escrow?
2 months.
Yeah, they were about a month behind. He came in and 2 weeks, we prepped for close, right? Started all over again, and we really get this thing done on to the finish line in 2 weeks. So being able to work with a direct lender like Arcstone, who knows the products, this isn't just a direct lender who doesn't know their products, we're talking about a team that knows their products, has major advantages for your customers that need this level of service. And that's where you get your repeat customers.
And it's just that LA could have lost that commission. That client could have lost that, that home they really, really liked. It's a missed opportunity. Again, I think it's passion. I talk about that in my office a lot with my employees, is that I'm super passionate about homeownership. It's really important for me to see a buyer have a great experience. And not have a mediocre experience is not even acceptable to me. It's just got to be that Neiman Marcus experience when you walk in. You have that go in and out without having to be shoved around, pushed around, and it's just not a good experience. So yeah, that's really, really important to us, and everybody over here invokes that passion as well too. They want to make sure that they give that same experience to our clients. So working quick, making sure their questions are answered. And also, if it doesn't fit a program, it's important for us to open our horizons and say, okay, they don't qualify for FHA, but they will qualify for four other programs. Let's offer that to the person and not let this decline button be pressed so they can start this process all over again. So thank you, Zoe.
You're welcome. I gotta go. Sorry. Nice to see everybody.
Bye-bye.
Thank you, Zoe. Good to see you.
Zoe. We're gonna head out to though.
Hi there, it's James. I had a question, or a couple actually.
Yeah.
So you talked about debt income ratio just changing recently. You said from 43 to 50. For how long do you think that'll remain like that?
I'm so sorry, James. John was a little noisy here, so I apologize. Do you mind repeating
Sure.
that one more time?
At the beginning, you mentioned that the debt to income ratio changed recently. I was wondering how long you expect that to remain. I just don't know how often these things change.
So as money becomes a lot more available, guidelines loosen. I don't expect things changing anytime soon unless we have another major crises. People are happy with the returns that they're getting, and the guidelines and the programs are performing. So I do not anticipate things changing, if that's what the question is exactly.
Okay, got it. And
Then
then,
it become a lot easier. So before jumbo loans, you'd have to manually underwrite. Now we could use the automated underwriting systems to underwrite them as well. So it's becoming a lot easier to give loans to people with a little bit more of a wider range, such as, if you have a little bit of a higher debt to income ratio, they're able to get them. It's really exciting for me to see, actually. It's always been that way. It got really, really tight in the 2008 times. And then with the COVID situation, it only exacerbated it. And now it's like back to normalcy.
got it. And then specific to your products, I'll just kind of go through it quickly. So for a bank statement analysis loan, you mentioned bank statements, but you didn't really specify whether you meant like personal bank statements or would it be combined with a business bank statement? Do you guys ever kind of like look at those together?
So yes, it depends on the business, right? So if you're a corporation, we'll look at your corporate bank statements. If you're a sole proprietor, we're going to look at your personal bank statements. So it depends on what your structure of your company is, but it's not going to be both at the same time because you're either depositing into your corporation or you're depositing into your personal account. So it's one or the other, generally, unless you have two corporations. Then we're looking at both businesses separately, and unless you have two separate businesses as well, one corporation and one side business as well. So we could definitely look at those. It's as long as it makes sense, but we can't just look at your personal deposits into your bank account as well that have no business relationships or business related deposits.
Got it. And then on an asset loan, how liquid do these assets have to be? Like, I mean, I imagine, you mentioned crypto, which is pretty liquid. Same with, I imagine, brokerage accounts, but like, what about trusts? What about, like more non-liquid assets, like investing in art, like vintage automobiles?
Wow, great question. But no, I love it. No, so on non-liquid like automobiles or art, we haven't gone there yet. Shouldn't say that. There's one program that we utilize it for net worth purposes, but for all intents and purposes, I would say cars and artwork are excluded. But you mentioned trust. Now, if the trust is a revocable trust and it's got an actual deposit or cash flow coming in from it, we could utilize that as long as you're a beneficiary or a trustee of the trust. If that's what the question was, am I correct?
Yeah, no, it is. It gives me a range of what you consider acceptable and what's not. So that's good to know.
Yeah.
And then on cash flow analysis, I assume that for purposes of an analysis, you're only looking for like the long-term rental potential, right? You're not looking at what would be short-term rentals. Okay.
Yeah, not like the potential of an Airbnb, but what a long-term lease would bring in.
Okay, that's it. Thank you so much.
Oh yeah, no worries, James. Thank you. Those were great questions, by the way. Very, very different. And are you an investor, James, or are you a realtor?
I mean, I'm just neither. I'm just a single individual. I mean, I work in investment for films, so I have a little bit of, I'm used to investments. So, but I'm not an investor, just speaking.
Yes. Yes. Well, it's great to meet you.
So is it safe to say, Marty, that mortgage bankers and organizations like yours can have better access to these alternative loan programs as opposed to those bigger nationally known banks?
Yeah, and I'm not saying that because of who we are. Absolutely, it's 100%. Yes, we're a lot more nimble. We're able to create these products faster. We have access to them. We're a lot more forward thinking. We're seeing the need for the product sooner. So you'll see it with the ideas of the TICs that we talked about a few minutes ago. When we see a need and we can actually securitize it properly, we'll bring it to market. We're usually one of the first ones to do so.
Yeah, no, I know that to be true. And actually, I'm just asking you that so you could kind of synopsize that. Because like the next part of my question is, what do you think about all these banks that are popping up online? I mean, there's SoFi. Capital One positions itself as an online bank, although they do have different banking centers between like Glendale, West Hollywood, I think maybe downtown. But then you also have like Rocket Mortgage, which I think might have merged with Quicken or vice versa. We're seeing a lot more online banking resources, and a lot of people think that it's very convenient. What are the pros and cons of that? And it seems like that might be competition. And I'm guessing potentially maybe they don't offer these AMP mortgages that you have.
So let me explain to you, so the word banking can be misconstrued sometimes because we are not a depository at all. We are a mortgage banking firm. We only focus on mortgages and we do not have any depository, whereas a Capital One, the banks that you're talking about, they're soliciting deposits in order to be able to give loans and other types of loans, like whether it's a car loan or a credit card. These are other types of high yield lending that they do. I mean, mortgages are at low threes, low twos at the moment in time. There's a little bit more profitability when you do higher risk loans, such as credit cards and or personal loans and commercial loans. Those are the spaces that Capital One and these online banks are positioning themselves with. So yes, they'll obviously play with they'll do the mortgage banking piece of it as well, but they're doing the agency products. None of these lenders are, in the non-QM, which is in this case the AMP programs that we talked about today. And of all the lenders that you mentioned or the banks that you mentioned, Rocket Mortgage is the only one that is comparable to us in the sense of that they're a mortgage banking firm only. They do not have depositories either. They're very similar, but they're just much larger online bank based out of Michigan, and they are part of Quicken. And so Rocket is their offshoot name. They got away from saying Quicken, so their Rocket Mortgage is their new name. But they're not in the AMP mortgage space either. So they don't have the programs.
Thank you for clarifying.
Yeah. So this is the reason why, guys, that a lot of these lenders are not going to be in this mortgage space is it's not a very streamlined, it's not a conveyor belt program. That's what those programs are. Middle America is generally W-2'd. Most of the United States is W-2'd. Everybody has a job, not a lot of entrepreneurship, not a lot of this type of borrowers. Obviously, we live in metropolitan cities. California attracts that. We have huge industries like entertainment over here that does attract that type of business, that type of gig work type of environment. So Rocket Mortgage and you've got these UWMs and all these other companies that have popped up. They are a conveyor belt type of a company where they just want to do agency, which is Fannie, Freddie, government loans, and as fast as they could get them done, and that's important to them. But these loans are very intensive loans, you got to really get in there and analyze a lot of things. So it cannot be scalable as easily. So we choose to do it because we believe in the idea of homeownership, because we want to make this available. But it's, Rocket Mortgage is not, that vision is not the same. They've got shareholders and they got to make money. So.
I
Thank
have
you.
a question. Sorry to, you may have touched on this. I had to jump off on a call really quickly. So if somebody were to want to buy an investment property to Airbnb, let's say in Palm Springs, for example, do you have any products that could take an Airbnb type situation into consideration?
So to acquire a property, no. But if you're refinancing a property, or if you have a property that we're going to use the rental income to buy another property, so if you have an existing situation, we'll use it, but not to acquire any property, because we don't know what the future rents are. With existing rents that you're bringing in from an Airbnb, you've got demonstrated income, so we can see what you're bringing in from that property. So when you're refinancing or you are, buying another property and utilizing that other property's income from Airbnb, that could be usable. But future rents with Airbnb, we have no idea. The only way to document it is to get a market rent analysis from an appraiser to let us know what that value would be of rents on a monthly basis.
So if an appraiser were to do a market, okay, so it would be market rents. Yeah, understood. Never mind.
For long term,
exactly.
Yeah, and just letting you guys know also, the other huge piece about working with Arcstone Financial, and I think Ellie experienced this, is that we have our own appraisal panels that we use. We hand select appraisers. We do not go off of pick that person from a pool of appraisers, basically.
But don't you have to use an AMC?
We don't use an AMC. We have our own panel that we use of appraisers. We're exempt from it because at a certain net worth, you can be exempt from it. But there's policies and procedures put in place in order to make sure you can have that. So it's not like, oh, this appraiser is going to hit the market. That's not how it works. But we select these appraisers that are on a panel. It's randomly selected to the appraiser, obviously, but it's obviously we're selecting the best of the best. We're not, at the end of the day, it's a waste of our time. It's a waste of the client's time. It's a waste of your time if we do not get that level of expertise in the appraiser to check the values and do the valuation properly. It's like if we have a loan that's going through a system, we're spending money. There's employees working on it. We'd rather front load and do a lot more quality control on our appraisers than waste money on employees working on a file that's not going to work, and also waste the borrower's $550. That to me is criminal, I feel like. So I don't like the idea of taking someone's money and then saying, sorry, the value didn't come in. That's just not how it works. And we do a lot of work ahead of time. As a lot of, the agents that have worked with us will know the value. If the appraisers, our appraisal panel also does work and they say, okay, this value is not going to be attainable. Do you guys really want to go forward with this? And then we'll call the borrower, call the agent, we'll say, hey, this is not supportable. It's your call. Do you want us to go get the appraisal and you guys can renegotiate the value at that point? Or do you guys want to just stop here and not waste money, basically? So those are the other wonderful things.
Oh, perfect. Thank you.
Yeah, of course.
David's question about the Airbnb. So if you, in the example you gave, Marty, what you didn't want to do is guess at the income of an Airbnb. But you're talking about potentially refinancing an existing investment property to pull money out to go ahead and use as a down payment on the next investment property. Let's say a rental, where you can be assured and look at market rates. Not Airbnb, but a regular rental. So is that part of the program that's doable here? Take an existing property, refinance it to pull money out to use to invest in the next property.
Absolutely. Yeah, that's totally doable. We'll take that, we'll utilize it, and you can take that money and buy another property with market rents or whatever it is that you can utilize. Yeah, as long as the equity is there and the rents cover it, absolutely. So we talk about this a lot with our clients as well, leveraging, and I feel like we do a little bit of a financial planning with them as well too. So we look at their thresholds, their stage in life and whatnot, and that's all of our loan officers, including myself. We do a little bit of a financial plan for the borrowers, borrowers and buyers as well too, saying, what is your goal? Like, are you trying to be debt free at a certain point? Are you trying to accumulate wealth and not worry about and have interest only loans on all of these loans and just not worry about so it just depends on your goals. And if you want to leverage it, absolutely, you can do that. You can take the money out and buy 2 or 3 other properties. And that's a common practice that's been going on recently, because I feel like it's hard to save all that money, but equity's been growing very quickly in many parts of the country, and a lot of people are tapping into that equity and buying other properties. You got muted.
Just a thank you.
Oh yeah, of course.
Do you guys
Oh, go ahead.
do you guys have a minimum loan amount that you work with?
James, I love your questions. I really do. Yes, it's 150,000. Oh, on the AMP program is 150,000. Let me clarify. On all the agency programs, there's no minimum.
Got it.
Great questions, James, by the way.
I know.
Mhm.
I mean, everybody has good questions. I mean, there's like very, very specifically different questions that I'm getting, which is awesome.
How do you work, Mardi, with people who earn or they are selling their properties in other countries?
So the question is, how do we work with people that are selling their properties in other countries? So if they're selling their property in another country, they're buying a property here.
Yeah, so they earn money from their family back home, let's say Dubai or somewhere there, and then they want to buy here.
Oh, so they earn money over there?
Yes.
So we'll do foreign, are they foreign nationals or do they live here? Are they?
I'm asking for a friend, she's from Iran, and she has a lot of properties there, and she wants to buy here next year.
Okay.
And I think she said what she's selling that is worth 1.5.
She's selling a property over there?
Yeah, selling properties of her family.
Yeah.
But here she's a student, she doesn't work, so she doesn't have much income.
Okay. So we just talked about, that's a great example. We've got a borrower that has a property in Iran. She's a student. She probably has good credit. And she's going to bring the money over to the United States and buy a property in California, I presume. And so as long as that money is, first and foremost, let's talk about this. Iran is on the sanctioned country list. So just know that the money coming in the United States is going to be a little bit longer. Just wanted to throw that out there. It's going to have to go through OFAC and make sure that it goes through the channels of making sure the money is clear. So that's first and foremost. And then secondly, I mean, that money is US money at that point. So it's in US currency. So, and she could use one of the AMP programs. So she'll probably, because she is a student and she doesn't have any income, we could probably do this as an investment property for her and do it as on a cash flow analysis. So, I mean, so as long as the rents cover the payments, she could buy a property.
And she can rent the property
and she can rent it out. Exactly.
Okay. Because that was a concern for her, and she said she went to the bank and they told her no.
But she has to have established credit, Mardi.
She made my case, guys.
Yes.
I don't know what to say. She went to the bank, she was told no, and we just provided the solution. She'll sell the house in Iran, bring the money here, and buy it on the cash flow program, where she doesn't have to provide any income documentation.
But you would have to have established credit in the United States.
She does have to have an established credit in the United States, and she is.
Yes, she's a citizen, but she doesn't have any income here. I mean, she barely works here. She goes to medical school.
So on a side note, also, David, you brought this up, and I don't know if we're way past our timelines here, but if you don't have established credit in the United States and you're a foreign national, we could do the same exact cash flow analysis loan program for a foreign national as well. You do not need to have established credit here. You have to put 35% down, and you can get the same program. So if you're coming in from another country, you say, I love California and I have money, you can definitely buy a place over here without having to be a US national or have a credit report out here as well too.
Great to know. Thank you.
Yeah, so it's a great way to advertise outside of the country too. I mean, Molly, here we go. The, the international market. Yeah, no, but it's definitely, there's so much money in other countries as well. I mean, and everybody, I was just in Greece a little while ago in July, and you know, you would think like Americans are looked down upon sometimes, you know, because of what we do. But a lot of people aspire to own a property in LA or in New York or any of these, you know, major cities, just because it's all over television. So yes, so there's a lot of people that have money outside of the country that want to buy, and they don't know the markets out here. They're afraid. They recognize that the US is super stable, and you know, we always have A-rated credit throughout the world. We don't have revolutions. We don't have collapses in our economy. I mean, once in a while, but but you know, it's a safe haven for a lot of people to put their money. So obviously, it's a good place to advertise as well, especially Dubai. So
Well, thank you. I mean, we're almost at 6:30. I want to thank everybody for coming here. I do have the schedule for upcoming live at 5s between now and the end of the year. For October, we have Dan Yukelson, who's the executive director of AGLA, and that's the Apartment Association of Greater Los Angeles. He'll be talking about some of the updates dealing with landlord rights and issues. In November, we have Tony Watson, who's one of our favorite speakers. He's a tax advisor with Robert Hall and Associates, and I always learn something new when Tony's on the line. And then in December, we're going to have somebody talk about TICs. The speaker's not identified yet, but that is a real hot topic and gaining a lot of popularity. So that will be our topic on December, and that kind of wraps up the year. 3 more months.
I can't believe it. I can't believe it's
Thank you,
almost at the end of the year.
Are we having fun yet?
Always.
Well, thank you, everybody, for joining us. And Marty, thank you so much for the amazing information that you shared with us this evening. Very, very.
Really, really honored, guys. Thank you for having me. And I'm so sorry about the technical issues. Thankfully, there was a conference room that I had to come into, but I apologize for my dial-up issues.
Bye. Bye.
Thank
Good night. Thank you, everybody.
All right, thank you for
Happy
joining.
Labor Day.
Happy Labor Day. All right, bye.
Bye, Mark.